All right, we'll get started in just maybe another minute or two and dig in a little bit on college savings planning. You know, it's an interesting time right now, but I think a good time to talk about college savings as these kids start to head back to school, which is something odd to say at the end of September or beginning of October, but that's kind of where we are, at least right now in Fresno. And it kind of forces us to think about what's ahead, particularly for the younger kids who still have a long ways to go before they head off to college. Now is a good time to really start considering how we're going to pay for college. So we'll get rolling in another minute here, and then we'll be off and running. I'll just say right now, if you have any questions as we're doing this, feel free to ask. You can put it in the Q&A section that we have. I'll try and make sure that I'm checking the chats and Q&A as we go along. And of course, you can feel free to email me directly or us here at the office. Our general inbox is info@fordfg.com. And so you can email with any questions that you have about the college savings planning stuff. So we're about 3 minutes after. We'll give it one more minute for anybody to log in who wants to and hasn't yet. We'll also work on getting a replay up on our YouTube channel. So if there's something that we cover and that gets missed that you'd like to replay and listen to, we'll have that available for you, hopefully in fairly short order, so we can have that available. And it can be for folks who have missed this as well. If you are wanting to do the presentation and something has come up after registering, we'll have the replay available for you as well. So let's go ahead and dig in. And as people join, we can kind of rehash a little bit if we need to. If you don't know who I am, my name is Brian Ullmann. I'm a financial advisor here at Ford Financial Group. And today we've been kind of working in this COVID world now. We often do, prior to the COVID world, we do seminars for our clients where we get together and talk about kind of pressing things, whether it has to do with the stock market or retirement planning, Social Security, and so on. Lately, we've been doing a monthly webinar, which is what this is part of. And this is one of the first times that we've actually covered college savings planning as part of one of our series of our client presentations. I think one of the reasons for that is college savings planning affects kind of a discrete group of people, whether it's parents would tend to be younger kids because there's more time to plan, or grandparents with younger grandkids, again, more time to plan, but worried about kids' college savings. And so I suspect that whoever is on this right now has kind of, it fits that mold. And I can tell you that I personally I'm in that category as well. My wife and I have two kids, Henry, who is 6, and Lily, who is 4. And so they are kind of right in that prime time of getting started with college savings planning. In fact, we've already begun it with our kids. And so I can talk a little bit about how what I do with my kids and can kind of personalize this for you so you can kind of see what your options are and what might fit best for you. This subject is also near and dear to my heart because I went to undergraduate and then even graduate school, specifically law school, and paid for it through a variety of ways. My parents helped me out, but student loans were a big part of my undergraduate and postgraduate experience. And so I think with good planning, you can maybe not eliminate student loans for your kids or your grandkids, but you can help reduce the burden that they're going to carry after graduation by planning well in advance for the expenses that you might be taking on. So with that, let's dig in. What I'm going to do is I'm going to actually cut off my video here so we can focus on the slides. But as I mentioned before, if you have questions, please feel free as we go to post them in the Q&A, and I'll try and answer them as we go along. So let me stop my video here. And so what we're going to do is begin by kind of looking at current and future college costs, and then we'll get into some of the ways that one pays for those costs. And so let's move forward here if I can. And so let's talk first about college costs. Because it's rare to pick up a newspaper or magazine without seeing an article about the increasing cost of going to college. And when you add up tuition, room and board, books, and other expenses, the total costs of a year at a public or private college can seem impossible to reach. You can see here that the College Board, which is a nonprofit organization whose mission is to connect students to college opportunity and success, they've been at this for more than 100 years, and they're a key source for college costs. And as you can see here on this slide, they estimate that for the 2019-2020 academic year, a moderate college budget for any in-state public college averaged a little bit more than $26,000, and a moderate budget at a private university averaged nearly $54,000. Now, we are in our office, our main office here is in Fresno. And so our local university is Fresno State. And so I went through and actually looked at the projected college costs for a student that would be starting if they were born today and starting school 18 years from now. If we were using just the current costs of tuition, room and board, books and fees and things like that, and with a 6% rate of growth, which is about on par with what college tuition has been growing at for the last few years, you're looking at projected college costs at Fresno State University 18 years from now at nearly $169,000. Now, if you need to spend $169,000 on something 18 years from now, it pays to get started early and plan and frankly invest in a way that can get you to where you need to go. So that's what we're going to talk about today, is some ways that you can pay for this pretty hefty expense that's coming down the road. I don't want everybody to faint knowing that an in-state student at a state college is going to pay almost $170,000 over 4 years. But this is what makes planning so important. So there are some ways we're going to go over today, some of the ways to plan for college. One popular way to save for college is to use what's known as a 529 plan. There are a couple of ways to use 529 plans. We'll get into this. They include basic savings plans and can also include prepaid tuition plans. Another way you may have also heard about paying for college or saving for college rather, is the COVERDELL ESA or Educational Savings Account. And it's another widely used method of putting aside money for college. In the last few years, 529 plans have probably been more popular than the COVERDELL accounts, but we'll get into the COVERDELLs. You also may not have realized that U.S. savings bonds can also play a role in saving for higher education. Now, I will admit already, savings bonds were a much more common practice 20 or even 30 years ago when you could get better interest rates from savings bonds, but they can still play a role here. And then another way of saving is through UGMA or UTMA, which is a Uniform Gifts to Minors Act, that's UGMA, and the Uniform Transfers to Minors Act, UTMA, and those can be arranged to help pay for college here. And so we'll get into that as well. And then finally, we'll finish off with student loans. But let's dig into what, quite frankly, is the most popular way to pay or to save rather for college right now, and that's a Section 529 plan. So a 529 plan is an education savings plan operated by a state designed to help families set aside funds for future college costs. Now, it's actually named after Section 529 of the IRS code, which created these types of savings plans. You probably hear names like 401k and 403b. These are all these silly numbers are all referencing IRS codes. But even though it's the IRS code that created this, the 529 plans are actually established by states, and almost all states offer at least one 529 plan. And the great thing about 529 plans or 529 plan accounts is that anyone can establish one. A parent, a grandparent, a friend. Also, the beneficiary can be anyone, even you. The only requirement is that the person be a U.S. citizen. I'll tell you a story here really quickly. We had somebody who worked here a while back, and he and his wife were having trouble getting pregnant, but they were trying, and he actually opened a 529 account in his name with the faith that they were going to be able to have a baby. And he started saving into that 529. And then when they were fortunate, they had a little girl not too long after that, and he was able to move that over into her name. And so 529s, I don't want to jump the gun and talk about portability here, but the idea is it doesn't need to be open just for a child. It can be open for anybody. So you could even open a 529 plan and put money away and then later pay for graduate school for yourself or something along those lines. There are two types of 529 plans. There's a savings plan, which works much like a 401k or an IRA by investing your contributions into mutual funds or some similar investments. And your account will go up and down based on the value and the performance of the investments. There's also prepaid plans that let you prepay all or part of the cost for in-state public college tuition. And they can also be converted for use in private and out-of-state colleges. One interesting thing to note about 529 plans is though contributions aren't deductible, earnings in a 529 plan can grow federal tax-free federally and won't be taxed when the money is taken out to pay for college. So it works a little bit like a Roth IRA, right? You take the money post-tax, you put it in, but the growth then is tax-free. And the person who opens the account rather, not the beneficiary, is actually the owner of the account and retains control at all times. And he or she, mom or dad, grandma or grandpa, whoever, can decide how to invest the money that's contributed, and then also, more importantly, how withdrawals can be used. And then, as I mentioned earlier, you can change the beneficiaries on the account to a different family member. And so the control of the account is an important thing that you'll see later, because things like that UTMA and UGMA account that I mentioned earlier, once kids get to the age of majority, they take control of that, or can take control of that. Here, it's the account owner that controls it, how it's invested, how it's taken out, when and for what. And then a question that I get asked a lot about is the portability. What if my kid doesn't go to college? What happens with this money? And we can talk a little bit about the withdrawal amounts, but what I see a lot of is actually when there are siblings, if one goes off to college and one doesn't, or something along those lines, things can be shuffled around. So you can move. I'll just use my kids for example. Let's say Henry doesn't go to college, but Lily does. We could take Henry's 529 plan and move it over to Lily's, and it can all be used for Lily's tuition. So that is a cool feature of 529 plans. And it kind of just reinforces the notion that if you put money in a college savings plan, it's not locked up. It's still yours. It can be used. We'll get into a little bit more about how it can be used. So if none of your kids go to college or none of your grandkids go to college, it doesn't just disappear on you. So let's move on to the next slide. Let's talk about contributions to a 529 plan. Unlike Roth IRAs and the COVERDELL ESAs, 529 plans have no income limits, no age limits, and no annual contribution limits. This is maximum flexibility. Initial minimum contributions often start as low as $25, and then monthly contributions can be as low as $15 in some states. I'll tell you, for contributions in the types of 529 plans we typically use around here, we usually open the account with $250, and then you can automate monthly payments for as little as $50. And so it's still really low bar there, kind of a low cost entry. Most 529 plans allow you to set it and forget it with automatic investments that just link to your bank account and do an automatic withdrawal like a bill pay or payroll deduction. I will say there are lifetime contribution limits, which vary by plan, and they can range from $235,000 to $520,000. So although there are lifetime contribution limits, they're very high. And I really haven't run into a situation, at least personally as an advisor, where someone was maxing out those 529 lifetime contribution limits. Also, for most people, estate and gift taxes aren't the issues. So contributions can be up to $15,000 per person in 2020, and they still qualify for the federal annual gift tax exclusion. So I'll go back to my family here. The contribution limits are per person. So in theory, just take Henry, for example, my 6-year-old, we could put in $30,000 because $15,000 would be applied to my wife and $15,000 would be applied for me as far as that gift tax exclusion. So you can really pile in big chunks of money into the 529 plans without running into any problems. even if you made contributions greater than $15,000, you probably wouldn't have any gift tax liability because you would begin using some of your federal estate tax exclusion, which is actually more than 11.5 million for anybody who died in 2020. So, and that's where you start running into gift tax issues. So really, it's not your contributions. You're not going to run into any gift tax problems when you're making it to your 529 plans. In any event, though, it's always smart to check with your accountant or your tax advisor about any estate or gift tax consequences when you're making these 529 plan contributions. Speaking of taxes, let's talk about income tax benefits that come with the 529 plans. Contributions to the 529 plans are made with after-tax dollars. So in addition to federal tax savings, 34 states, including the District of Columbia, currently offer residents a full or partial tax deduction or credit for 529 plan contributions. We can help you check if you're not in California to see if your state contributions would qualify. I can tell you here in California, your contributions to your 529 plan aren't deductible from your state taxes. So, so that's a little bit of it's not an issue, but you don't get that added benefit here in California. When we talk about taking money out and withdrawals being tax-free, qualified expenses, when we say the money has to, in a 529 has to be used for qualified expenses, we're talking about tuition, fees, books, supplies, equipment, room and board, even, so dorms and meal plans and all sorts of stuff like that. And when we're talking about eligible institutions that you can take money out of, it's virtually all accredited 2- and 4-year public and private colleges and universities in the US. It even includes some vocational schools. And then there are a number of colleges and universities outside of the US. We have a client actually that had a 529 and her son went to college in Tel Aviv. And the school actually we were able to use the 529 to apply to tuition there for the university in Tel Aviv. So withdrawals have two parts, contributions and earnings, right? If you think about what's in that 529 plan, you have the money you put in, and then you have the growth that came from the money that you put in. And so if a withdrawal is taken for a non-qualified expense, so none of the expenses I just talked about, the earnings portion will be subject to federal and possibly state income tax. So you can take the money out, but you might have, you might be paying taxes on some of this. And the earnings portion of the withdrawals taken for non-qualified expenses are actually subject to a federal penalty tax of 10%. So think of it like an early withdrawal from a Roth or something like that. So, you know, the IRS is trying to encourage good behavior here, so you get some benefits of tax-free growth if you're saving, and if you take it out and break the rules, there's a bit of a tax penalty that can come from that. Selecting a plan is an important element here because we want to select the right plan. And there, as I mentioned before, there might be tax advantages to using your state's plan, like deductibility of contributions and matching contributions and tax breaks for qualified withdrawals. And the tax features alone might make your in-state plan appealing, but it's still worth checking other states' plans. In California, we don't have those tax benefits. And so we really kind of can go everywhere through all of the available plans throughout the country to find one that fits best for you. So, you know, we want to consider some of the important factors into account that we look into when we do the research on what state plan to use. State tax benefits and negative tax consequences for non-residents isn't the only one. We want to look at what investment options are available, how much investment flexibility is available. We want to be mindful of fees. We talked a little bit about this already, but we want to be mindful of the minimum and maximum allowable contribution amounts. We want to make sure that we're mindful of the restrictions on who can be a beneficiary, what kind of options there are for account access. We also want to be mindful of the process for making withdrawals, whether or not a paper documentation is required or whether payments can be sent directly from the plan account to college. So I would say, I'll take this opportunity to say, you can look into this yourself, or you can work with us here at Ford Financial Group and the advisors here to make sure that you're choosing the type of plan that works best for you and what you're trying to achieve for your student that you're trying to save for. So I will tell you, full disclosure, 529 plans are what we use in my family for my kids. So I'm not just talking the talk, but I'm walking the walk. And it's the right fit for us. Now, that doesn't mean that 529 plans are definitely going to be the right fit for you just because I'm using it with my kids. But 529 plans have proven to be the most popular way of saving for college because of the kind of flexibility and the amounts of money that you can put in there and save for your students. I would say the next most popular way to go is a COVERDELL ESA. So a COVERDELL Education Savings Account, which is what ESA stands for, is a tax-preferred savings and investment account that's authorized, again, by the IRS to encourage people to save for future education costs. They were previously known as education IRAs. And so if you've heard that terminology in the past, this is just a new name for the same kind of thing. The COVERDELL Education Savings Account became a very attractive college savings vehicle for many people, including families that wanted to save for elementary and secondary school expenses, as certain K through 12 expenses were added to the list of qualified expenses for the COVERDELLs. And for that reason, even if you like the 529 plan, you still might decide to contribute the first $2,000 of your savings for each child into a COVERDELL savings account. But that brings me to some of the items that we need to be aware of when we're talking about COVERDELLs. The first is that the contribution limit is $2,000. And moreover, you need to be careful when accounts are being established, COVERDELL accounts that is, are being established by different family members for the same child, because if total contributions exceed $2,000 in a year, a penalty is going to be owed for over contributing. And so you need to be mindful. You don't want to have parents opening up 529s and grandparents and aunts and uncles, or I'm sorry, COVERDELLs rather, because the contribution is $2,000 per child, not per parent contributing, like we discussed in the 529. Also, an important difference between the COVERDELL and the 529 is that the beneficiary of the COVERDELL ESA must be under the age of 18 at the time the account was established. So that trick that one of our old employees used to open it in his name and then move it to his daughter's, that can't be accomplished with the COVERDELL. And then third, the relatively low contribution limit means that even a small annual maintenance fee that's being charged for holding your ESA could actually impact your investment return, because as a percentage, it's a larger percentage. And so that's something to be mindful. It's always important to be mindful of fees, but it can be impact, I guess, COVERDELLs a bit more just given their size. And then also fourth, to keep in mind that your contribution goes into an account that's going to be eventually be distributed to your child if it's not used for college. You can't simply refund the account back to yourself like you can with most 529 plans. This means you lose a degree of control with the COVERDELL ESA down the road. I will say though, the ESA is on fairly equal footing with the 529 plan when you're applying for federal financial aid. The account's actually considered an asset of the account custodian, which is typically the parent. So withdrawals aren't reported as student or parent income as long as it's tax-free for federal income tax purposes. So I'll just kind of end on this slide by saying that the other hang up with COVERDELL ESAs is that coordinating the withdrawals with other tax benefits, especially the Hope or Lifetime Learning credits, can be a bit tricky. So that's another kind of hindrance here. And then I guess finally, the account has to be withdrawn by the time the beneficiary reaches age 30, or it's going to be subject to tax and penalties. We don't run into that very often with these, but it's another difference that makes these COVERDELL ESAs less flexible, I guess, in the 529 accounts. I will say though, when we're talking about tax benefits, earnings in the ESAs, in the COVERDELL ESAs, are tax deferred just like the 529 plans. And similarly also, if withdrawals are used for qualified educational expenses, like we discussed earlier, room and board and fees and tuition and things like that, they're also going to be exempt from federal income taxes. So if a withdrawal is used for non-qualified educational expenses, then the earnings portion of the withdrawal is subject to federal and perhaps state income tax. Also, in most cases, the earnings portion of withdrawals taken for non-qualified expenses are subject to that tax penalty of 10% that I mentioned before. And so even though there are some exceptions to the penalty, the general idea here is that you're going to get penalized if you're not using it for qualified educational expenses. I don't see any questions yet. I've been going for a little bit. I'll just remind you, if you have any questions, that you can pop it into the Q&A box, and I'll be checking that regularly in case you have any questions on the 529s or the COVERDELLs. Moving on from the tax benefits here. Oops, let me get back into this. There are also some contribution and income restrictions that come with the ESAs. Contributions to a COVERDELL ESA, similar to the 529, are made with after-tax dollars. And so regardless of the state, these contributions aren't going to be tax deductible. Annual contributions to any COVERDELL ESA is still going to be limited to a total of $2,000. And I'm going to stress this again. The $2,000 limit is per beneficiary, not contributor. So if the same beneficiary is named on two accounts, the total for the two accounts can't exceed $2,000 a year. Given the cost of college, you can't save with the COVERDELL ESA in the same way that you can save with the 529. Contributions can be made, though, until the beneficiary reaches age 18. And there's a higher age limit for special needs students, but there's that restriction there on the age. And then you get into income restrictions on those who can contribute to an ESA. So without going too deeply into it, if you're single, if you're filing single and you want to know the contribution limits, I'd say get in touch with us. I'll just touch, if you're married filing jointly, the full $2,000 contribution can be made if your modified adjusted gross income is $190,000 a year or less. Those in the $190,000 to $220,000 category can make a partial contribution, and then you can't make any contribution. The COVERDELL ESA is out of the question if you're married and your modified adjusted gross income is greater than $220,000. So keep that in mind as you're considering these different plans. So we can talk about, I covered account control a little bit already, but just a reminder here that an important difference is the beneficiary of the COVERDELL ESA or his or her guardian of the beneficiary has to be a minor. And they can take control of the account when they are no longer a minor down the road, and they can make withdrawals anytime. As I mentioned, that there's a special needs exception there, but it's important to know that you're going to lose, if you're a parent, you're going to lose control of this at some point. But similar to 529, you see in the last bullet point here, balances can be transferred without any tax penalties to another member of the beneficiary's family. It could be the spouse, grandchild, brother, sister, father, mother, etc. So those are the COVERDELL ESAs. I think they were more popular before 529s really got rolling in the way that they have. Another way that we used to see college savings go on was with U.S. savings bond. There are two different kinds of bonds that gets used here, Series EE and I bonds. The interest can be tax-free. And so some of the interest, some or all of, frankly, of the interest earned by the savings bonds can be excluded from income. But the bonds must be qualified. So you can't just use any bonds. It needs to be the Series EE bonds issued after 1989 or Series I bonds. And they must be issued in the name of the taxpayer, not in the name of the person for whom the education expenses have been paid. So qualified education expenses, in this case, include the tuition and fees. But unlike these last two ways of saving in the COVERDELL and the ESA, expenses don't include room and board when you're using savings bonds. Frankly, I don't see this much anymore, the savings bonds being used for qualified educational expenses or for tuition and fees. The 529 plans are still kind of the way to go. I did want to include this, though, because it's still a valid way of saving. It's just not one we see very often. Another valid way of doing this is the Gifts to Minors Act. And so accounts can be set up in the UGMA, Gifts to Minors, or UTMA, Transfers to Minors Act. And they've been used for years and years to help pay for college tuition. One of the advantages that these offer is that a portion of the earnings in these accounts can either be tax-free or taxed at the child's tax rate. And taxation is at the parent's rate until the child reaches 18, but there's some flexibility there. The real disadvantage here to these methods is that once the child is no longer a minor, he or she controls the account and how the money is spent. And depending on the act and the state, the student is no longer a minor, somewhere between the ages of 18 and 25. So we talked about control before with the 529 plans. That's one of the downsides here, is that at some point you're going to lose control again. And you don't want money for tuition to become money for a sports car or something like that with your student. Some financial planners suggest keeping a UGMA or UTMA account if you already have one, and you spin down the account for the benefit of the minor, and then you open up a new 529 plan for all new contributions, which is an interesting way to go. Either way, these savings vehicles can be kind of complicated, both from an estate planning and an education funding standpoint. So we always have to say, be sure you consult with your tax advisor on how to coordinate it, but we can also work with you on how you might do that if you have an existing UTMA or UGMA account. Those are the options that we're covering today for saving for college. That's not the only way you pay for college, though. There are different ways, and I'll kind of roll through the different ways of student aid. As I mentioned before, student loans were certainly a part of my undergraduate and postgraduate experience. The U.S. Department of Education has 2 federal student loan programs. There are the kind of under these programs, there's the direct subsidized loans, where the loans are made eligible to undergraduate students who demonstrate financial need. It helps cover the costs of higher education at a college or career school. In those cases, repayment has to start within 6 months of graduation or leaving school, or going below half-time attendance. And the current rate for loans in 2020 for this is a little bit more than 4.5% for undergraduate students. There's also direct unsubsidized loans, which are available to the same kinds of students, but you don't need to demonstrate financial need to be eligible for the loan. But you pay interest on the loan and it begins accruing immediately. And that's the difference between subsidized and unsubsidized loans. But the same repayment, the repayment works kind of the same way. And frankly, the interest rate is about the same for the subsidized and unsubsidized loans. There are also plus loans that are made to graduate or professional students or the parents of dependent undergraduates for expenses that you haven't saved for. These are the plus loans are really for the parents that we see often being taken out. The same repayment as the subsidized loans apply, and the interest rate for loans dispersed in 2020 is a little bit north of 7% for graduate students, so a higher rate of interest. There's also a way to consolidate these loans, and if you are familiar at all with student loans, consolidation often goes on right after graduation. It allows you to combine all of your eligible federal student loans into one single loan with a single loan servicer. Now, loans aren't the only way to go. There's also grants and other types of like a Pell Grant, for example, and other student aid grants that are available as direct aid, which essentially means you don't need to pay it back. But oftentimes those are based on financial need and the cost of attending college. I put the website, the www.nassgap.org. That's a mouthful. That stands for National Association of State Student Grant and Aid Programs. And you can go there and find out a little bit more about the aid programs and grants that are available. And then lastly, I have private programs on here. Don't forget about private assistance programs. There are corporations, foundations, communities offer scholarships and grants and endowments. And so many of those aren't primarily based on financial need or academic achievement. It's simply an application. If you're applying and you intend on engaging in a particular field of study, you might have I'll just use like a local bar association may have a grant for an undergraduate student doing pre-law or something like that. I don't know if that's actually going on where you are, but you get the idea. It can be really diverse based on backgrounds, your pursuits. It doesn't necessarily need to be based on needs. So those private programs are also worth looking into for paying for college. Student loans are, accumulating at a rate that's almost kind of mind-blowing. There are about 45 million student loan borrowers with outstanding student loans, and the total student loan debt is estimated to be $1.64 trillion in the US. I think also surprisingly here is not just the size of these student loans, but student loans actually have a delinquency rate of 11.1%. And that's for loans that are 90 plus days delinquent or in default. And the average student that graduated from the class of 2019 has a student loan debt of nearly $30,000, which is kind of concerning for all citizens. But really, it doesn't just end with the students. We see student loan debt across the board. It doesn't just affect these recent graduates. It affects people even into their older years. So you can see here just on this slide, the current outstanding student loan debt based on age. Now, 62 and older is probably parents really it's more likely that their parents taking out money to pay for their undergraduates and they're taking those plus loans, for example. But you know, when you're in still that 35 to 49 kind of band of students there, those are students who graduated, 15, 20 years ago, but are still paying off their student loans. And so I think this just speaks to the need of planning well in advance for your students, because it doesn't just help your students graduate without student loan debt. It can help, if you're the parent, you getting your kids through college without burdening yourself with loans and a lot of loan payments. The problem with student loans is that the failure to make loan payments can be pretty serious. It can mean that your personal credit score takes a big hit. It can make you ineligible for certain government jobs. Colleges are encouraged by the Department of Education to actually withhold transcripts from people who are behind on payments. And that can be a problem if you're a college graduate trying to get a new job. And in some states, you can even have your professional license, like your nursing license or driver's license, suspended for defaulting on a student loan. So if you're behind on payments, I would encourage you to get in touch with us. We can help with this. Temporary simple solutions can include asking the lender for a suspension of payments for a particular period, or a reduction in the amount of the payment for a certain period of time. There are a lot, especially for the subsidized and unsubsidized loans from the federal government, there are lots of different payment options, and you can kind of be flexible depending on what's going on for you. And then there's the advantage that I mentioned a little bit earlier of consolidating loans into just one monthly payment, which can actually result, if your interest rate is lower, in a lower monthly payment. And it can also lower your monthly payment because the repayment period gets extended beyond what the original loan was requiring. So I would say it just generally, as with any kind of debt, it's important to be on top of this and be mindful of what's going on here, because defaulting on things can certainly have an impact. And then I'll kind of start to wrap this up by just touching on income tax considerations. There are credits available that can help pay for college experiences when you do your federal to income tax returns. There's the American Opportunity Credit that provides a tax credit up to $2,500 per year per student. It can be claimed for qualified higher education expenses for students in their first 4 years of post-secondary schooling. There's income limits here that kind of can affect whether you can take advantage of the credit. I'll just skip ahead to the married filing jointly here. If you're married filing jointly, the income limit is $180,000 for 2019. So that can affect the American Opportunity Credit. There's also a lifetime learning credit that allows a tax credit up to $2,000 per year per tax return. And that can be claimed for qualified educational expenses for students at any stage of their post-secondary education. Like the American Opportunity Credit, there are income limits here. In this case, it's $136,000 maximum adjusted gross income if you're married filing jointly. And then there are also some tax deductions for qualified educational expenses that you can find in the IRS code. I would say work with your tax preparer to try and find some of that if you're paying tuition directly, because it can get around those gifting limits that we talked about a bit earlier. So we're still going here. I don't see anything in the Q&A box. So I think we can kind of begin wrapping up a little bit here. We've covered Section 529 plans, which frankly are my favorite. It's what I use for my kids and what works for my family. COVERDELL ESAs are a popular option, maybe not quite as popular as 529 plans because of the lower contribution limits and some of the inflexibility. And then bonds and UGMAs and UTMAs have worked in the past. I'll say because of some kind of structural concerns with the way those operate, they're less popular. And then we also covered student aid and student loans and some tax credits as we went through here. So I think one of the things that I kind of explain to clients is that paying for college is not just one thing. It doesn't, you don't need to pile 100, you know, like I mentioned in the beginning for Fresno State, $170,000. You don't need that in a 529 plan. As you can see from this list, college gets paid from a variety of ways. One thing's not listed here is that students can also work. I know that's not a popular thing right now among students, but they can get a job and they can work and also support themselves. And so college gets paid for a variety of ways. It's often some sort of grant or scholarship, plus a 529 savings, plus some federal and state student aid, plus a job, plus a help from mom and dad. So there's no silver bullet that when it comes to college, paying for college tuition and educational expenses, but 529s or ESAs or whatever it is that you're using to plan ahead for can have a really big impact to ease the burden down the road. So I will leave it there. I can answer some questions at the end. We've got some disclosures here, obviously, that we've got to roll through. If you have questions for me, you feel free to email me. My email address is my first initial and last name. It's BULLMANN@fordfg.com. If you're already working with an advisor here, I would encourage you to email your advisor directly. And if you don't know your advisor's email address, you can simply email info@fordfg.com, and we can make sure that your advisor receives the email. We will route the email to your advisor so they can answer your question directly. I'll jump in here and I'll stop the screen share, and you've got me back on video. I can answer any questions that you have. We can take a kind of another couple minutes if there's something to address here. Otherwise, I think we can leave it there. We're going to do our best to be able to post this recording for everybody to see down the road, because if you've got young students that you're worried about saving for, you might even be homeschooling them right now, unfortunately, with all of this COVID stuff going on. So we want this information to be as accessible as possible for everybody. So I guess if there are no questions, we'll leave it there. Thanks for logging in for our September webinar. We will continue to do these as time goes on until we're able to get back together in person. So I'll leave it there. Thanks for watching.